Why do we believe rising interest rates will continue? And why do we think that the Fed will overshoot? That's because, Jamie Dimon called it an economic hurricane. You've got three components here that are really driving the bus. You've got supply chain problems, you've got the Fed, and you have what I call commodity inflation and wage inflation. And those don't always move in tandem. So what the Fed is looking at right now is they're looking at the CPI and they're saying to themselves, okay, we're going to get that CPI down. The problem is the CPI is being caused by supply chain issues. For example, when you sanction Russia and you say Russia can't use the financial system, it's like a body. You choked off, you've cut off the circulation in the arm. That's going to affect the rest of the body. All these economic systems are very fragile, and when you disrupt one, for example, if China has lockdowns, that gets on everybody. So the pandemic started the supply chain problems, meaning we couldn't get goods and services from one place to another. Then enter the Biden administration with their sanctions on the war. They've been a disaster, to say the least. They've hurt Western civilization. They've certainly hurt Europe, and they've hurt really everybody but Russia. But it doesn't matter. They're going to continue on with that. And so the supply chain issues and our inability to get goods and services because of these disruptions, that's what's driving the CPI. The Fed, on the other hand, has two tools that they use to control inflation. They used to have one tool, which is just the short end of the curve, but now they got two. They've gone out and put $9 trillion on their balance sheet, so they now control the long end of the curve, which is makes it more difficult to deal with this environment. And what the Fed has accomplished, they've moved the dollar up. Traditionally, all commodities trade in US dollars: aluminum, oil, gas, steel, everything. And so when you move the dollar up, it takes fewer dollars to buy a barrel of oil, say. So oil's gone down about 36% from the high. The dollar's moved up about 15%. So you're getting about a 2-to-1 bang for your buck there. So the Fed is accomplishing that. And I'll give them that. The problem is they're looking at the CPI and they're going to continue to raise rates until that CPI comes down. But it's not being caused by your traditional inflation. It's being caused by supply chain disruptions, meaning we can't get goods and services. Goods and services are not moving freely and in an orderly fashion. You put these sanctions on Russia, you think you're hurting Russia, but they got on everybody. And they're going to continue. They just came out with this chip thing, this chip bill. They're going to try. We can't sell chips to China. Well, that's stupid, because then Nvidia will just sell their chips to Europe, and Europe will sell them to China or India or whatever. And so now you add a layer of cost to those chips. That's all you're doing. The chips are China's going to get their hands on the chips. But these kind of intrusions on capital markets is not good. And it's a fragile system at best. So having said that, that's our conviction, is that the Fed is looking at CPI, and if you look at it, it's gone from 875 down to 825, and we've raised rates 4 or 5 times. It's having very little impact. But the Fed may look at it and say, oh, it is having some impact, so we'll just continue on. So that in a nutshell is why the Fed is going to continue to raise rates, and it's not going to work. And so you say, well, what's the result of that? Well, you're going to slow the system down even further. So we have supply chain problems, and now you're going to raise interest rates, and it's going to slow it down further. We think unemployment by second quarter of next year will get to 7 to 10%, and that's the U3 number. That's an important number, and I want to highlight that up front here. I think that's your windshield number. You want to be looking at that U3 number. The negative correlation between the U3 number and the equity markets is about 74%. meaning as the U3 number goes up, the markets go down. So we think that's been set in motion. Unemployment ticked from 3.5 to 3.7 last week. We're looking at that to go to 3.8, 3.9 next month. And you might say, well, that doesn't make any sense. All these people, there's all these people available and all these jobs available. How can the U3 number be ticking up? Because the media's got it wrong, and they're highlighting all the jobs nobody really wants. But if you look at what's really going on, you've got Apple, you've got the banks, you've got Snap, a myriad of high-tech companies are already laying people off and have, and we see that continuing. So the unemployment number should tick up, which is a bit of a conundrum. And because we should easily be able to get to full employment. If we have all these jobs available and all these people that are just, theoretically sitting at home, you think they want to go back to work. And in addition to that, this problem may persist because what the pandemic did, particularly with small businesses, is they learned that they could operate with half as many people, for example, and they just double their prices. And this is a hypothetical example. They didn't exactly double them, but some industries I'm sure did. And so businesses have learned to get by with fewer people, and it's easier. I go from 20 employees to 10, or I go from 50 employees to 25, and I'm making even more money. I'm not going to hire anybody. I'm just going to keep my prices up as long as I can. So that's another problem, and that adds to the unemployment situation. So that's a bit of a conundrum and a little unusual, but this market's a little unusual. And so, so unemployment will tick up. The Fed will ignore that, and they will just continue right on doing what they're doing.